Good afternoon, everyone. My name is Menno Holsoff, and I'm here with Baytex TD. Joining us today from the company is Ed LaFair, President and Chief Executive Officer, and Rod Gray, Chief Financial Officer. By way of background, Ed first joined the company in 2016 from TACA, where he was President of its North American oil and gas business, and Rod joined in 2014 from CEDA International. Ed, maybe you can kick things off with a few minutes on how you're thinking about the business strategically and where you're focusing your efforts operationally, and then maybe you could also just touch on some of the lessons learned from this latest downturn.
Yeah, sure, Menno, and thank you. One thing's for sure, we're missing Sam Speed. It's great to be here. It is great to be here at your conference again. And I think, as most of you know, we've been pursuing a deleveraging strategy since the time I joined in 2016. And then teaming up with Rod and others, we started moving that strategy pretty aggressively. So in 2018, we executed the Raging River merger. In 2019, just last year, we paid down $330 million of debt. With FX, it was more like $390 million of debt, a lot of free cash flow that year on $57 WTI. And then in Q1, we refinanced our debt, terming out our bond maturities to 2024 and 2027, and we extended the maturity of our revolving credit facility to 2024. So it was a big quarter for us on both operations and the refinancing. And then COVID hit around early March, the time just after we refinanced, and we changed our priorities to really focus on financial liquidity, maintaining that $300 million of cash on our revolving credit facility, and focusing on our people and business continuity. So far, we've had no COVID cases or disruptions to our operations, and we've done a lot. So what we have done is cut capital by 50%. We shut down drilling in Canada. We moderated the pace of our development program in Eagle Ford. We shut in 25,000 barrels of oil equivalent per day voluntarily, all in Canada, and that was all April and May, and we reduced costs by $135 million. So we announced our full recovery plans on June 25th, where in June we brought back 20,000 barrels a day of the 25,000 barrels a day that were shut in. So those 20,000 barrels a day, or 80% of our shut-in volumes, are all back online. We added hedges June, July, August, sort of this summer time frame, really focused on the near term to support the cash flow of those assets in an extremely volatile situation. Of the 20,000 barrels we brought on, 5,000 were light oil and 15,000 barrels a day were heavy oil coming on throughout the month. And then 5,000 barrels a day remains offline and probably needs on the order of WTI $45 and differentials about where they're sitting now. So we're getting very close to the point where we're looking at bringing back those additional 5,000 barrels a day. So we stated in that June 25th press release that at strip prices, we would maintain greater than $300 million of financial liquidity through year end and not break any covenants related to the credit facility in 2020 or 2021, as long as WTI prices remained above $39 to $40. So our objective clearly is about maximizing cash flow and trying to generate some free cash flow through the end of the year. What I'd say about your question about what we've learned a whole lot over this last 3 or 4 months. One is the hallmarks of Baytex we always knew were being nimble, executing well, and having a flexible business model with drill complete tie-ins. We don't have any large facilities or large, long lead capital projects. So we created a new plan in weeks or days with the pressure on. We executed that plan simultaneous as we were planning, and we were all working remotely during that period very effectively, and still are. So all of those things we would have thought going into this would not be as possible nor efficient, And now we're actually thinking a good portion of what we've learned through this COVID-19 new way of working could be a way of working for the future. So pretty excited about that. But I'll go ahead and stop there and turn it over to you, Menno.
Terrific. Thanks, Ed. So maybe I'll just start with a high-level question on the asset portfolio. Clearly, commodity prices are all over the map, and differentials have been, they've stabilized now, but they were pretty volatile as well. As you look across the portfolio, which asset or play would you consider the most competitive at the moment on the strip, and then which would you consider the most challenged, and what can be done, if anything, to enhance the returns on those assets?
Yeah. Well, the play that's most competitive is the Eagle Ford. It's got break-even development costs sitting in the mid-30s. It's not all created equally. There's some in the low 30s and some up towards 40, but we're still in one of the best parts of Karnes County, let alone all of the Eagle Ford trend. And as I've said publicly many times, I believe we're in one of the top 10 counties in all of the United States. So it's our first call on capital. It's our operator's first call on capital. With the Dakota Access Pipeline, it's probably even more so going to be our go-to asset. On the most challenged asset, it's got to be the 5,000 barrels a day that are shut in, which are a mix of heavy oil properties from Lloydminster to Peace River. And as I said earlier in my remarks, I believe we need $40 plus WTI, probably around 45, but with differentials as tight as they are, we're starting to look at whether or not to bring on some of that now, although we've stated we're likely to leave it shut in for the rest of the year. Not if WTI keeps moving as it is, sort of 20 to 30 to 40 cents a day. So that's what I would say. The other thing on how do we make ourselves more competitive and better returns, we do have some small non-core assets that we've been looking at selling in the Deep Basin for a while. It's got a lot of ARO and would be a bit of cleanup, so we've been looking at that. We've got a pipeline and a gas plant in Peace River we don't need to own, but we do. And the other thing is we're driving our DNC costs down every day to make our Duvernay and our new Clearwater play, as well as some of our existing assets, more competitive.
Since you mentioned it, just on the M&A side of things, what do the interest levels look like right now on smaller non-core assets like the ones you described?
Pretty difficult for sure over the last quarter. People were focused on doing exactly what I just outlined we did, and that was all hands on deck, all oars in the water, and full consuming. So I don't think there was any time really for people to look at A&D from about March through to June 1. I think now oil prices stabilizing in that $40 range, people getting through their RBL season. We're not an RBL facility. I think, as everybody knows, we're covenant-based and have strong bank support. But I think somewhere around the end of the summer or maybe end of the year, that M&A picture will come together more clearly. But it requires some of the intermediates and smaller players to get through the RBL season. But I think most basins that we're in are ripe for consolidation. Certainly the cold flow heavy oil, Duvernay, Viking is pretty well already consolidated. Eagle Ford will continue to consolidate. And then I would just argue in general, the capital efficiency of the business has to improve, must improve to be competitive with other sectors. And therefore, scale doesn't just matter to investors because of relevance in terms of certain screens, but it matters in terms of cost competitiveness and margin competitiveness. So size can create greater profitability. And if it does, it's a wonderful thing. If it doesn't, then it was the wrong thing to do. But there's a lot of it left in oil and gas.
And then just to move back onto the Eagle Ford, you mentioned that it is the most competitive asset at the moment. Marathon is clearly the operator. So can you just talk to the extent of alignment with Marathon and whether activity levels would have looked any different had you been the operator? And maybe, the follow-on to that is running room within the Eagle Ford. You've been in that play for quite some time, so maybe you just talk to, what's left in terms of drilling locations, et cetera.
Yeah, sure. We and the operator have been aligned ever since I've been here, and as I understand it, since the day we purchased the asset, right through the downturn, and that was somewhat of a roller coaster in terms of some years had higher activity, some lower, but it's always been our first call on capital, and similar to the way we see it at Marathon. We would have moderated activity even as Baytex standalone if we were the operator. They have moderated the activity from 22 net wells on our acreage down to 18 net wells. So that is moving us from about 35,000 barrels a day plan or budget to about 33 to 34,000 barrels a day annual average for the year. We would have done that anyway because we want to ensure free cash flow for our own corporate purposes, and they do as well. But as I understand it, this is the play that's receiving most of the capital attention within the operator's company. And other key areas, Permian, Oklahoma, are shut down. And with Dakota Access, I think that will create even more demand for capital coming into the Eagle Ford play. So we like what's going on there. We like the incremental improvement every year on well performance. Costs are down even this year versus last year. There's strong demand on the coast for our light oil, attracting a premium to WTI, moving into the refiners at Corpus Christi. And we have a long life inventory. So maybe a lot of people don't realize this. It is maturing as an asset, but we had 250 net locations coming out of our reserve report, and that was putting on roughly 22 to 25 net wells per year last year, and that was our planning base. So we'd always set around a decade of inventory. Well, if we're only putting 18 wells on a year in a new normal of $40 to $50 WTI, I would say our inventory is greater than 10 years because we've got that 250 net locations, and primarily in the lower Eagle Ford. It's a wine-racked approach to develop the lower and upper Eagle Ford simultaneously, as opposed to putting sticks in each one of those horizons. But yeah, there's quite a lot of, we can hold this flat for a long period of time. It's a strong cash flow and free cash flow dividending asset. And that's exactly what fits with our needs right now as a corporate strategy.
And then if we move on to the Raging River assets, maybe you could just give us an update in terms of the performance relative to your initial expectations at the time of the acquisition.
Yeah, well, they have the Viking and the Duvernay, and now we hold it, and we bought it for both, not one or the other. The Viking has been excellent. We produced at the highest level that Raging River or Baytex had ever produced before in Q1 of this year at roughly 25,000 barrels a day. So highest in our history. Costs were extremely competitive and low. Better decline rates. We're seeing better decline rates than when we first purchased it because we pulled back the activity. We're now running it more like the Eagle Ford as a flat producer generating free cash flow. And it's outperformed certainly last year. And this year it's also expected to generate free cash flow. And it's our highest netback asset in the company. So it's last year it was greater than $40 a barrel. This year again it will be a higher operating netback asset than even the Eagle Ford. So we couldn't have anything better there, we think, in the mix of oil assets across the right basins, we think. And then the Duvernay looks outstanding in one area, and we're not so interested in the other couple of areas. So it looks outstanding, I would say, in the Pembina subbasin furthest to the west. We've got about 250 contiguous sections there, greater than $50 WTI. It really looks like the new well performance The well we delivered last year, 1,300 BOEs a day, and a $7.5 million well cost, is getting in the neighborhood where it starts to look very attractive. Never before, it was, when we bought it, it's more like $60 WTI, but we knew there was a long way to go in terms of the frac technology and the cost structure. And so that's where we are there. We've got 2 wells drilled as of Q1, and we've chosen not to frac those yet, but we will do. They're in the heart of the play, and will be a good test of repeatability of that big rate that I talked about, 1,300 BOEs a day, and the cost structure. So really excited about both areas. We did 15 deals in the Viking last year to bulk up inventory as well. So we're quite active in those 2 areas, and we're better for it for sure as a company.
And then if we move on to, you've still got rough numbers, 5,000 barrels per day of shut-in heavy production. You suggested that some of that might come back on relatively quickly. If we look at differentials right now, they're very tight, both WCS, WTI, and WCS Maya. What are your expectations on the heavy differential through the end of the year if you assume that curtailed production comes back online across the industry? I'm assuming that's going to be a bit of a headwind for the differential, but it would be good to get your thoughts on that.
Yeah, well, the forward strip is probably not too bad an indicator. It shows full year at $13, but we're through half of the year, so we see 3Q low, and then it pops back up from $9 where it is today back up into the mid-teens by end of the year. And we do think that the mid-teens, with all the production on that formerly was available to move through pipe, should be in the mid-teens. And we know that partly because the full cost of rail, which we're continuing to rail, by the way, is around $18 a barrel. And pipe economics should be around $12 a barrel. The pipeline's a bit stuffed. So mid-teens has always been kind of our view where things would level out. But rail was sitting at 350 to 400,000 barrels a day and has gone to zero. So we would think that we're in 4Q, if the differential starts moving up, we should start to see rail move up such that that differential stays in that mid-teens area, 15 to 17, or kind of worst case where we had been when we were really oversupplied, about 17 to 18 or 19. So that was where I would see it based on a whole lot of factors, some new and some old. But the question is how much supply is going to stay offline or not be developed. There's some pretty significant decline rates in some of the heavy oil properties. And I don't know where the supply is going to end up in Canada, what the big oil sands players are going to do. And certainly all the SAGD existing is going to come back online. But there's very little capital going to work. There are 6 rigs running in Canada, all of Canada, onshore rigs, I believe that is. So it's a question of that activity level and what decline rate starts to creep in, and there will be a decline rate. So I'm very confident that differentials are going to stay in that kind of mid-teens range, and I would still say at $45 WTI, that's not enough to get really excited about developing heavy oil in Canada, right? So I think the supply is going to, some of the supply, whether it's the new wedge or some of the existing production, will stay offline or will not be available for pipe.
So your best guess right now is that we potentially do not transition back into oversupply into 2021?
Well, I think balanced. I do think we'll be balanced, but to be balanced, I think rail will have to come up. It may not have to come up 400,000 to 500,000 barrels a day where it was. It may have to come up a couple 100,000 barrels a day. But yeah, but I think we'll be relatively balanced, and I think declines will set in as people don't do any development.
Interesting. Yeah, and that's certainly been the feedback from some of the other panels as well. And I'm looking at the time, and I'd love to keep this going, but we are timed out. So I'd like to thank both of you for your time and insights, and looking forward to catching up in person at some point in the not-too-distant future, I hope.
Yeah, thank you, Menno, and thanks everybody on the call for taking time.
Take care.
Bye-bye.